is ever evolving. And I can tell you my experience from the past 2 years itself, the kind of fintech regulation, fintech developments we've seen, and of course the regulations that will come after that is just amazing. Today we're going to talk, I think we'll probably spend 20-25 minutes on kind of a very brief presentation I've got for you here, talking about insider trading. And of course after that, if there are any questions, any comments, it's a lot of it is not very intuitive. And you'll see the reason why when I talk about the case which came from the Supreme Court just less than 48 hours back, called Abhijit Rajan versus SEBI versus Abhijit Rajan. I'll probably spend 2-3 minutes on that. After that, I also came here to kind of course, make a recruitment fish call. So I think your 3rd, 4th, 5th years are here. And just give you a little introduction of who we are, what we do, because we are quite small and we're not very public. We don't talk about the deals we do, etc. So just a bit of a session on who we are. And of course, again, followed by any questions that you have, etc. So let me take you straight to the concept of insider trading. And as you can see, the devil is in the detail. What is key is, why do you need a prohibition on insider trading? Anybody has an idea why? What's the point of prohibiting insider trading? Just remember, the law against insider trading didn't exist till maybe 60-70 years back anywhere in the world. So why did some gent in some regulator decide that this was something which was not okay?
Certain people with inside information will have the power to manipulate the market, and then security is supposed to be access to the public, and everyone should have fair chance to it. That's when you get monopolized.
So, partly true. Let me ask you a follow-up question. What does manipulation do to the stock price? Does it make it more efficient or less efficient? What does insider trading do?
When someone has inside information, they then...
Does it bring price closer to value?
It could also inflate it greatly.
No, that's not the definition. So essentially there's a key difference between manipulation and insider trading. Manipulation is interfering with the free forces of demand and supply. It changes the market price, takes price away from value. And insider trading is trading by an insider. We will look at who an insider is. To trade at the fair value of the security, because the market is not trading at the fair value. Market does not know X information, and therefore it's trading at a discounted or an inflated price, and you kind of trade on that price, and then your trades, for instance, there's good news. Let's say the quarterly earnings are very good. Your decision to purchase based on that inside information will bring price closer to value, right? So it's actually slightly different from manipulation, but I like the way you think. Anybody who wants to take a stab at why is insider trading bad? When 60-70 years back, nobody really bothered about it. Even till 30 years back, nobody really thought it was some very grave evil which had to be stamped out.
So have you seen that insider trading is particularly bad because someone who is already in the company, now we know that shares are decided by the market value, and if someone is inside the company, they can buy more shares, or they can just put it out in the market to project an image which is not actually the true image. They can just project that the company is very healthy, and that is why we are buying up more shares, and that can be done through insider trading.
Okay, so again you're kind of deviating towards manipulation. You're saying people are trying to take price away from value, but that's a fair point, but that's not the answer. What is the origin of insider trading?
I think so dealing in securities market entails some risk, and whenever there is insider trading, one of the persons in the market takes away that risk element and is taking a short profit, and that diminishes the equality in the market.
Why short profit even?
Because
Some people are born with no money, some people are born with so much money. Does that make the rich person evil? I mean, it's an opportunity which is there. I mean, you start some business which nobody else had thought of, you kind of create value out of it. So, what is so inherently evil about it? I'm looking for a two-word phrase which goes back there.
The money of the general public goes into like hands of a few people who have unfair advantage.
Okay, you're getting there now. Okay. Who else wants to take a step?
So
Who have a fair play in the market.
Okay, you're getting there. What? Bomber, not yet.
So basically, you end up getting a head start over the others.
A lot of people are head start.
Then you have insider information.
Yeah.
And also, why it has become relevant recently is because of the advent of equity.
I want the 70-year-old answer. Yeah.
Because they're equity shares and they shouldn't. I mean, insider trading is going against that. The whole principle have the equity shares.
Looking for a phrase with two words. Yeah.
So the information which should not have gone out to the public has been communicated to the public, and some person who has communicated that information has used that information to like undue profit.
Okay, I will give you a counter example. Let me take two more. Yeah, good. Back there. You just shout.
Short profit is there.
Yeah, what are the
So it is an opportunity you may or may not succeed, but here there is confirmation that you will get the money. You will have a profit.
Again, you're not getting to the evil of it. You're getting to the exorbitant profit kind of. Even monopolists make exorbitant profits. Yeah.
It's a public offering. That's the case.
Sir, isn't the undisclosed rights sensitive information? Sir,
What you learned in corporate law?
are you looking for a phrase or are you looking for a person?
Looking for a phrase, a concept. A phrase which describes the concept, which is the origin of insider trading.
It gives benefit to certain amount of people.
Who? That's my point.
Insider trading.
Who are these people? Okay, I'll give you an example to answer this. Let's say there are two directors of a company going in a taxi. They talk about the quarterly numbers of the company or annual numbers of the company. Very extremely high price sensitive, profits are double of the company. Nobody outside the company knows this. The taxi driver is a graduate from IIM Ahmedabad. He can analyze numbers and he understands there's something good happening in the company, and he goes and buys huge number of shares of the company. Then next day the information is made public and makes a huge profit. Is the taxi driver an insider trader? Why not?
So because through the recent developments, these are not considered as employees or insiders.
Why?
So he used information that is available to public at large.
No, it was not available to public. Available to only 2 people. Yeah.
Since you talked about a concept which is taking steps from, does it step to document corporate gain?
No.
Because in that case,
Okay, let me answer. Yeah. Last.
So it's unfair to other investors.
Why is it unfair?
Sorry.
Why is it unfair?
Because they don't have the information which you have. So you are trading according to that information which the other investors don't have. So it gets unfair for them.
It is unfair, no doubt about it.
So they had access to confidential information, which others did.
So what relationship is what I'm getting? Yeah. Yes, there you are. There you are.
Also, the price sensitive information is available to only the people who have fiduciary relationship with a company.
That's exactly the point, right? So it is evil because the information has been given to specific insiders out of a fiduciary duty that they will use that information for corporate businesses and corporate purposes and for no other purpose. And when they put their own personal interest ahead of the corporate interest, they are in breach of fiduciary duty. So it actually the origin of the concept of insider trading is breach of fiduciary duty. And it's limited. Classically, it was limited to the orderly in the company is not considered the insider. It's basically the top end, directors, top management. Again, we'll see how we deviated away from that original concept, but that's what is known as the classical theory. Okay, so can somebody? This is kind of obvious, right? Reduces space in the market. All the directors are making profit all the time. Obviously, all it's a kind of a zero-sum game, so other people will be losing consistently. So it reduces the faith in the market and therefore liquidity and capital formation. Most dealers are speculative. Here's a counter question. Why is insider trading good? We've established it's wrong, it should be banned, it is banned. Can you think of any reason why it's good?
Sir, it keeps the director invested in the company, like they care about the company, that they want to make it grow. That they have invested their own money in the company, so they will take care of it.
Maybe, but I'll come to that.
Because it helps attain the actual true value of the share.
Yeah, what I said earlier. Yeah? Brings price closer to value. Good for the efficiency. What else? You're getting there, but that's the point which I just explained.
So I had a question.
No, question later, first answers. Why should insider trading be legalized? Again, you may laugh at the idea of legalizing insider trading, but some of the people who have been advocating this have won a Nobel Prize in economics. So the so-called Chicago School of Thought. So one is it brings price closer to value, and it's a form of insider compensation. So these are kind of two of the couple of other reasons, and also kind of then there will be again that's the theory that once you allow this, there will be an incentive for people to perform, and then of course use the inside information. Again, I don't think any country does that, but it's an intellectual school of thought. I don't think it's kind of a completely absurd thought process to legalize inside trading. Okay, so prohibition is no insider share. Trader communicate unpublished price sensitive information. And there's an exception for legitimate purposes, performance of duties and legal obligations. Classic example is somebody wants to acquire a company, they do a due diligence. So classic insider trading. You have access to inside information which nobody else has. You look at let's say the financial of the company, and you invest based on that inside information. So it kind of makes you an insider. You're traded based on the unpublished prices. Therefore, they had to carve out an exception for legitimate purposes, performance of duty, legal obligation would be submitting to regulator. So you mentioned in fact that insider trading, you use the word manipulation. If you look at the US law, there is no law which says thou shalt not commit insider trading. It comes from what is famously known as Rule 10b-5 or the rule against fraud. So there is no law which says that breach of fiduciary duty, any inside information result in a trade will be prohibited. It all comes from the law against fraud, and we'll see how why that has an impact. But broadly in India, we've taken different route. We have defined fraud in a separate regulation, what the Securities lawyers call FUTP or fraudulent and unfair trade practices regulation, and we have a prohibition of insider trading regulations. Who's an insider? So, classical theory, as I said, is essentially the senior people, right? The senior management, directors, etc., who are in possession of law, in possession of certain price sensitive information. What is price sensitive information is, what is material. All of you have learned materiality in your courses, so you understand. And it's usually kind of a very factual question. There's no legal answer to what is material. It's in the markets you can guess when something is material based on what happens when that information hits the market. If the market goes up or down, that you have a good sense that it's material information. Right? It's present. But again, you will have to do the analysis before it hits the market. Where is information unpublished? Again, there are some smart cookies who kind of sit on the tables, and as soon as it's information is made public, 5 seconds after that they trade. Right? That's not considered to be okay. And again, this law is evolved to say that no, you have to let's maybe 24 hours pass before you do the trade, or the information to seep into the market. As I said, the classical definition of insider is the senior manager, but we'll see the example, we'll see the Indian law has veered towards the taxi driver also to be part of insider. That's called the possessions here, we'll come. Those of you who studied fraud know that there is a concept of causation, right? And there are two, I'm not getting into both the concepts, but there's something known as transaction causation, which means A results in B, B results in C, and therefore A causes C. Right? So you need transaction causation, and you also need what is called reliance, which is, in classic example of, let's say, an IPO, you make a wrong factual statement in an IPO document which is 500 pages long. Under classical laws of fraud, a person would have to show that he or she went through the entire 500 pages, looked at footnote number 324, relied on it, traded, and faced the loss because of that, which is an impossible standard. So again, there are kind of shortcuts to how you prove reliance, which is another form of causation. That your reliance on the misstatement has caused you loss. Again, that's a session. That's a topic for another session. Today we are not going to get too much into that. But in the context of insider trading, the fact of the trade can show materiality and causation. So just when you discovered 50 billion barrels of oil, your company discovered 50 billion barrels of oil and nobody knows about it, and you buy a huge number of call options in the market. Right? That's usually evidence that you are trading based on insider, because there has to be a causal connection between your trade. And how do you break it? You can also break it. For instance, you have fantastic information and you trade, but you can show that the sale of shares, the purchase of shares, or usually the sale of shares occurred because let's say you had a surgery in the family and you needed the money. So you can break the causal chain through facts. But usually, if you sell on bad news or buy on good news, then it's presumed that you trade on the basis of the information. And as I said, you can break the causal chain. But it's usually tough. And it's a question of fact. Materiality and price sensitivity is the same thing. They're not similar, they're the same. And it's a question of fact, which is based on the indicated probability and the anticipated magnitude. So if the magnitude is huge, 50 billion barrels of oil, even if the probability is kind of somewhat limited, you may or may not be able to extract it, for instance, it still becomes material. So it's a combination of little factors, and it's very factual. Okay, so the basic rule is disclose or abstain. So if you have certain price sensitive information, you can keep quiet, right, and not trade. There's no obligation. There's usually no obligation that every time there's price sensitive information, you jump and go to the market and tell your competition. That's not what it means. But so long as you have some price sensitive information which is not yet public, don't trade. That's why the disclose or abstain. Once you disclose, you can trade. Right? When does information enter the public domain? I just told you. You need to let it seep into the market. Selective disclosures are not okay. Again, this is very common even 10 years back, which is top management of a company would usually call research analysts into the cabins and talk about all kinds of information which is not public domain. This was outlawed first in the US and subsequently in India as well. Which, in fact, a couple of months back, SEBI also said you have to simultaneously broadcast it. You have to put it in public domain through a webcast. Any kind of private conversation that you have with, for instance, research analysts. So this is kind of somewhat new. Now this is something which is very interesting, which is insider cannot be prosecuted under 10b-5 unless there is deception. And as I said, the law against insider trading comes in the US from the law against fraud. In India, we've not gone that way. So long as you have those 5 elements, which I just showed you, you're insider, you're an access person, you trade based on the basis of that information, and there's may or may not be profits. you can be charged. So the classic example is the taxi driver. Just 48 hours back, the Supreme Court has Indian Supreme Court has essentially injected this clause into the Indian law. This is the SEBI versus Abhijit Rajan case which I just mentioned. You should Google it, it's not a very long read, it will take you 20 minutes to read. Where it says, okay, facts are important, so maybe I was thinking I'll talk about it at the end, maybe I'll just tell you the facts in 30 seconds. So there is this managing director of a company who, while in possession of information that two contracts were being rescinded, which was considered may or may not be price sensitive because the value was only 1% or something of the turnover, so it was not very big number. There were actually thousands of crores, but it's for a company of that size, which is Cabinet India, it was relatively small percentage. So this gentleman, Mr. Rajan, he after these two contracts were rescinded, but before they were made public after 2 weeks' time from that date. He sold a large number of shares, and SEBI, of course, went after him and said, while you had this information, before it was made public, you decided to sell these shares. Finally, of course, SAT kind of exonerated him, and SEBI went up in appeal to Supreme Court, and Supreme Court held in favor of Rajan, saying that number one, the information was actually not negative information. The rescission of the two contracts actually would have and did result in an increase in the stock price. And that is exactly the opposite of what a rational person would do. Nobody would want to, take either the route to insider trading is guaranteed profits, right? Or guaranteed avoidance of losses. It can never be guaranteed acceptance of losses. And when a person knows that the information is good and sells ahead of that, that is almost the opposite of the definition of insider trading. Right? And number two, he was selling because he needed the money to give. The company was in distress. It was in corporate resolution, and he needed to sell the shares to be able to finance the CDR mechanism of the company. So he was in a way, he was the white knight trying to rescue the company with that money. And SEBI had not denied that that money was actually used for that purpose. So again, if you think about it, direction of the trade, again there are SEBI cases which say that direction of trade is not material, which is bizarre of course. And also cases which say we don't need any element of fraud. You don't need bad motive, you don't need anything else. So long as those 5 elements are satisfied, we will charge you for it. Supreme Court said no. So in a way, it's injected the element of fraud into, there has to be some mischief involved. Every time you satisfy those 5 clauses, you cannot charge somebody with it. Okay, so these are the 3 theories. I'm actually not going to spend much time on misappropriation, but I'll give you an example. So, classical is what I told you. Possession is also what I told you, the taxi driver. Some random outsider has access. You're walking down the street and some paper falls from a corporate building and it has the financial numbers, and that looks like good information you trade. Nobody's passed on information, nobody's been crooked, nobody's done anything unethical. Somebody accesses, it's like you're walking on the road and you find a 100 rupee note on the ground. You pick it up. Are you a criminal? Probably not. Should you have given it to the police, etc.? Maybe yes, but then make you criminal. So the Indian theory is more towards possession, subject to what I just told you about the Rajan case. Misappropriation theory actually comes from a lawyer. There is a gentleman, a lawyer in the US, who was advising. Again, you can process it a bit later, but there is a distinction between who you are advising. Think about it later, but if there's a hostile acquisition of a company, right, your fiduciaries of the target company were important. If you again go back to first principle of insider trading. So the lawyer of the target company, yes, clearly covered under even classical theory. Right? Trades while knowing that hostile acquisition is not yet public and trades insider. No questions. What about the lawyer of the acquirer? Has no access whatsoever to inside information. Hostile acquisition, I have told you. No due diligence, no access. If they were to call up the target company, they would bang the phone on them. So zero information from the target company. Right? So this lawyer apparently, name was O'Hagan. Everybody knows what happens when there's a hostile takeover, right? The target prices go up. So the lawyer for the acquirer decided to purchase equity shares of the company, actually call option of the target company. The acquirer was not used. And he was prosecuted for insider trading. Again, there were lots of defenses saying that I had no information of the target company. But again, the US Supreme Court held that this was under this new theory which they created called misappropriation theory. They held O'Hagan guilty of insider trading. So it's a somewhat convoluted theory. We have two Indian cases also which are similar to that, where the acquirer's fiduciary actually was. It's not very logical. I really don't buy it, but anyway, that's the law. I'll tell you one more story. So there's a gentleman called Dirks, again US case. He was an analyst, research analyst, and he decided to, he used to come out with newsletters, so obviously he had to have content for the newsletter about multiple companies, and he decided to look up a company which he thought was conducting a huge fraud. He spoke to ex-employees, dug around, went to the factories, visited them, and he said that this is definitely a fraud. There's no way these numbers stand. And so what did he do? He didn't publish it. He chose to go to the Wall Street Journal. The Wall Street Journal guy laughed on his face, said, "Get out, this is a blue chip company. There's no way that what you're saying is true." He went to the SEC multiple times, and again SEC threw him out, saying, "Blue chip company, you must be joking, you're some crazy guy, don't come back." So finally what he did was he did not wait. He put it in his newsletter, and obviously all his clients traded this short sold shares of the company. The price fell dramatically, and once the price fell, then there were investigations which started, and of course they finally uncovered that there was indeed a massive fraud. Guess what the SEC did? Classic insider trading. You spoke to ex-employees, current employees, you got access to information which was not in public domain. You tipped off your clients, paid clients, who sold short shares of the company, who made profits therefore. You must be an insider trader. And of course, it was only a rap on the knuckle, but he decided just to go all the way to the US Supreme Court to fight against this obnoxious order of SEC. And this is what the US Supreme Court said. Tipper should have made a personal benefit. There has to be a breach by a tipper of his or her fiduciary duty. And TP has to know of the breach. The taxi driver will not be guilty under this standard. Okay, so this is the tipping standard. Possible sanctions, usually, obviously penalty would be there if you commit insider trading. There's also a concept called disgorgement, which I think most of you may have got up, which is basically taking away the ill-gotten gains. It's not the same as penalty, and it's exactly the amount of profit that you made or the loss that you avoid. In insider trading, there's also the concept, every time you trade based on inside information, you are not cheating that one person on the other side of the trade. If you're a buyer, you're cheating the entire sell side of the market. So, again, we don't have class action lawsuits, but again, this has been examined very closely by US courts, that something known as chronological privity. So, every person who sold shares in that time period, in those 2 hours, can sue you. Right? Maybe for only 5 paisa, but they can sue you. So yeah, that's it. I'll probably take questions for 5 minutes if anybody has comments, questions. You had a question at some point.
I just had a question between what's the difference between So I had a question about what's the difference between price and value?
Price is what is traded, value is what is the intrinsic worth. Again, nobody knows that. And maybe someday when I come back, I'll maybe do a whole session on what is known as the efficient capital market hypothesis. It's a very interesting topic which is also connected to the session on fraud and the concept of reliance investment. But it's a longer discussion.
Wouldn't it be difficult to realize insider trading in India?
Will be louder.
Yeah, wouldn't it be difficult to legalize insider trading in India because
Yeah, it will be impossible anywhere in the world. And again, see, as students, you should be curious enough to know alternate viewpoints. And as I said, these are not absurd viewpoints. And these are viewpoints which were thought about 70, 80 years back, and they said, okay, things look okay, let's not get on disturb things right now. So, in fact, since I've of course written a book on, that's the cover of my first edition book, a kind of very vague sort of insider trading case did exist 120 years back. So, again, they're kind of more centered around fiduciary, but very similar to what you see today. So, it's been around for some time, but it's really kind of evolved in the sense being evolved only by, I guess, by the early 60s, 1960s in the US and late 1980s or early 1990s in
So I had a question regarding how do we encompass relatives as insiders? Let's say there are three types of relatives. First one being the relative, the second one being the immediate relative, and third one, the relative you had certain estranged relationship with that relative. So do we see the actual possession of the UPSI while proving the quotient evidence?
I'll be brief on because it's a slightly somewhat longish answer, but the broad quick answer is that relative is defined very narrowly for the purpose of insider trading, which is kind of immediate kind of parents, kids, spouse broadly, if they are dependent on it. So if you have independent kids, then they're still relative. But for the purpose of the deeming provision of relative, that if I have access to information, they would automatically have the deeming provision that exists if you are not a dependent relative. Yeah.
So it's a follow-up to his question only. The related party transactions, as such, the definition of related parties, while the regulations takes it very narrowly, I think there was some case law which interpreted some.
Which is also a recent Supreme Court.
It's a recent Supreme Court case only. It was a very contradicting position.
No, it doesn't. Okay. So I have not touched that because this is supposed to be half an hour. We're already 15 minutes. The basic thing with Indian law against insider trading is it creates relationships to be deemed insiders. So I'll give you an example of my answer. Right? So let's say I advise a listed company about some random thing. And obviously multiple phone calls are there, records are there that I have called, so no conversations are recorded, but obviously the phone company has this thing of the calls being made to senior management frequently. That is speaking to CEO 5 times a day for like a week. I just happen to have bought shares of the company in this period. And again, as I said, this is the advice I am giving it with respect to something completely vague and has no price and information. The week after that, the quarterly numbers come out and they're brilliant. They're like double their profit. There's a very good chance that you will come after that. Look, the CEO is talking to you 5 days a week. You are a fiduciary. You are an access person. You deem to be an insider because lawyers are deemed insider, just like a previous guy. You now come and disprove that you have not committed insider. And guess what? That's impossible. Unless I have a camera on my head 24 hours, how do I disprove the fact that no inside information was passed on? And as practitioner, I can tell you, we come across this very frequently, where people who are not guilty are being charged and there is no way they can disprove it. Which is also the reason I don't buy equities, despite being securities lawyer, I only touch mutual funds. I don't touch equity. I have not touched equity for 15 years. Because life is full of coincidences and these are not things you can prove. Disprove that.
So I just have a simple question that isn't that a little unfair to the people who are actually running the business? Because if, for example, you're the founder of a company, you would definitely have access to those listings before the entire public does. And just because you are the founder, you are putting in your sweat, you won't be able to buy those equities or you won't be able to buy those shares because you might come under.
No, it's not unfair because you're allowed to buy so long as you're not pregnant with the inside. You can buy the rest of the year. So there are kind of usually there are close-out windows in which the system itself will not allow you to trade. So it's conceptually there's nothing unfair, but the rebuttable presumption is what makes it perverse at times. Not always, but at times. When you can't prove you kind of guilty unless you prove otherwise, and you can't prove otherwise. Yeah.
So you just mentioned that you invest in mutual funds. So I just wanted to know your opinion on recent SEBI's proposal to include mutual fund units under the regulatory framework of insider trading regulations.
So I told you the deep stuff is wrong. This would be perverse. I've written an article on it. So those of you who want to read it can see the ETR. Anybody else? Yeah, somebody back there. Let's take this one or two more and then we can. Again, I'm around for 10-15 minutes later, so any questions which are. Yeah.
So what's the main significant difference between front running and insider trading?
Right.
How to distinguish? This is also connected to the mutual funds.
Right. So front running is also a breach of fiduciary duty. It's usually when you give a classic example is of a broker or a research analyst. Broker, you call up a broker and say that buy 50,000 shares of Infosys. And the broker says, oh, okay, I know this guy is going to buy 50,000. That's going to raise the price by 1 rupee. And punches in his own order before my order is punched. So again, the origin is actually both of them have the origin in fiduciary duty, but they're kind of somewhat different beasts and different regulations. One is insider trading, the other falls in FUD.